Paul Tudor Jones knows how to call a market crash, and at the moment he's buying Bitcoin and gold in this geopolitical situation. But what does that tell us about spooky October and what tends to happen for the rest of the month? Today we talk about 5 days up. That's how many sessions we've seen strength in this current market. But with a week like this and a rejection happening at this stage into the earnings and inflation report, there's a lot to discuss. Semiconductors are at supply and something sneaky is happening in hypergrowth stocks that all of us tend to like. Let's discuss stocks, commodities, and cryptos right now, including the big dark pool transactions of the last 24 hours. Well, welcome back everyone to The Daily Show, where we discuss the macro lead indicators and of course the hottest charts right now. If you like anything to do with markets, remember to subscribe and of course smash that like button. It does help us out. But without further ado, let's talk about the strength in the markets and the weakness areas. Everything to do with technology wasn't doing as well as it usually has been in this recovery, and it was more a day of utilities. And that's right, hypergrowth. Yes, the stocks that have been bashed recently were coming back through, and this could show us something very important about the next moves in the market. Let's also discuss whether we've seen the low. Bullish Percent Index had another great session on it, and just like we talked about at the end of last week, we believe that we could have been finding at least a temporary bottom. So far, that's been correct. Congratulations to so many people out there. You guys called it, and of course, we've been correct together. Let's talk about analysts' forecasts, though, of 4 of the last 6 US banks and what they think is going to happen this week. So we know that we're coming into earnings season, and we know that what happens with the banks tends to lead into kind of sentiment drivers for the rest of the month. But it looks like the banks aren't coming with the market. Basically, the market's going like this, and the banks are going sideways. This can tell us something about market internals, and we'll discuss that a little bit later on in today's video. Another chart that we'll need to be watching, follow us on Twitter or X in the links in the description down below, is going to be yield changes. Remember, we have the CPI or inflation report coming on later this week, and this is going to do some drastic shifts to the federal funds rate futures. This is going to mean a big thing for bonds, and of course, it's going to mean a huge thing for what the market's expectation is. And take a look at this chart. Already, since everything that's happened so far, we've already started to see rate cuts starting to be brought forward. It was that we were looking at June and July for the first rate cut. Now we're coming back into March. And this chart, I'll update you quite a few times through the week over on our Twitter or X account. Remember, anticipated earnings, keep on this book. Make sure you're aware that this Friday is the big one that kicks it all off, really. There are, of course, some airlines coming in on the 12th, but really it comes down to Tesla and Netflix. The most important sectors in the market are always semiconductors and tech, and this is a great snapshot if you're interested. Do also keep in mind the type of risk that we're taking into each and every earnings event. Expected options moves, I'll be updating you on this as well, but Wells Fargo, Citi, etc., between 6 and 7% implied move. So it's going to be a very volatile earnings season. I think we need to be aware of that one. We mentioned that we may have seen the bottom in treasuries. Now everyone's starting to talk about it again. Basically, treasuries have been possibly the worst investment of 2023. Of course, there's always worse, but they've been pretty damn bad. They've had a top to bottom of like 60%, and it is the worst sell-off in treasuries ever. So when we start to move 2 standard deviations away, we've got to pay attention. This is pretty rare, and it does show us that we should be looking for structure on the charts. Remember, when we bring data together with the charts, we're starting to get more powerful. And that's a lot of what this channel is about, and why you guys should subscribe and smash the like button if you do enjoy the content, because I believe this stuff helps us all out as a community together. What about the expectation right now from most retail traders and most professional investors? A lot of people are bearish, rightfully so. We're given so many negative inputs. Of course, you would think that was what was going to happen. But as we mentioned last week, we thought we'd get a bounce due to this, and so far, so good on this. We do now think, though, there's probably going to be a turn, and we'll talk about that a little bit later on. But you can see here the bull-bear spread is back down to the negatives, which usually means a market sell-off is met by bull demand. And this comes back to maximum pain, which we'll bring up later on today's video. What happens for the rest of the month? Well, so far it's doing a good one. Basically, we've seen strength so far. That's expected. And then we usually see some kind of pullback weakness in the middle of the month to the end of the month. And then we see strength usually for October into November, into December, and the Santa rally. And this is because when we have similar periods of this, you know, the stats don't lie. We tend to have actually 100% track record by the end of the year. Now, of course, it's just a statistic. It doesn't mean that it's going to happen. Past results don't necessarily indicate future, but this is in similar times when we had an S&P 500 up over almost 20% for the first 7 months. Then we had weakness in August and September, which we did this year. And what happens in similar times? We do have some years that are a bit of sell-off, but by the quarter four percentage, it's 100% they've been up. So it's a stat that we should be paying attention to. Let's move over now to dark pool activity. Well, it's been a while since we can talk about this one. Solar ETFs. Yes, a recovery and a significant dark pool transaction happening down near the low. We won't probably cover this chart today, but we will be looking at it in the future because this is now forming what could be a low for hypergrowth stocks. And more importantly, for clean energy, for solar and many others. They have been horrible performers this year. And seeing a transaction such as that certainly gets our ears pricked up and it makes us start to think, well, we need to be paying attention to those charts. What about the financials ETF? Well, again, some large transactions coming in. Are they buys or are they sells? Well, the earnings report is probably going to be the big one here, but certainly some transactions going on. You can see by this chart, and we'll look at it later on, that basically financials are not performing very well. Have they recovered in recent days? The answer is yes. Have they gone anywhere near the points where they were before? The answer is no. And they're sitting at what we would call a pivotal point in markets. If they start to sell, watch out down below because, of course, if financials don't present well, it often tells us a first warning sign that something in the economy is quite sick. We also seen some large transactions going through in, of course, the S&P 500 and Qs. And subsequently, we saw a nice rally in the previous session followed by a drop down wick, which could tell us something that maybe they were sells and we just haven't seen them move around yet. So we'll be on top of that one and, of course, paying attention to it. The last one is treasuries, of course. Even more transactions coming through. There's actually another one that's happened since this point. So it could be that we've found the low. Someone is certainly buying treasuries at this stage. Let's move over to the options world. There wasn't too much transaction going through in the options activity. We still see a lot of S&P 500. We still see a lot of Qs. And you'll notice as you scroll through here, some of these companies, especially the treasuries, are still getting significant amounts of calls on them. 263,000 to 142,000 puts. We want to see that reverse if you're a treasuries buyer. And why I say that is unless this is like more of a short squeeze kind of amount of open calls, generally I like to see huge put walls coming in to markets to kind of like protect that low. And that's what we actually saw across the board before we got the rally of last week. Go back and check, I think it was like a Wednesday or Thursday video from last week. It was a significant change in options. I mean, it was wild what happened there. Total volume was 36 million versus 39.5, and we saw 53% calls and 47% puts. So again, a little bit more of the call buying, but still a significant number of puts in the market. And we'll get an updated chart on small trader puts, and we'll put that in the next video so you guys can see how many small traders were buying puts through the last week and why so many of us got trapped and, of course, got destroyed by that move. And that's because everyone was starting to get super negative on markets. Clean energy and TAN, these two, solar as well, was doing incredibly well. Utilities, one of the sectors we've liked in the recent couple of days because of its massive sell-off. And funnily enough, regional banks were also doing quite well in the session. So we've got kind of all the most hated sectors doing well over the last 24 hours. And that shows us that this could be more of a broad-based buy-up. And it's something we need to be paying attention to should we now get a sell-off in the markets. For the last 5 days, gold's been the best. Nice work for people who got that. Semiconductors continuing up there. And funnily enough, in 1 day, pretty much clean energy has gone to second best on the charts. Notice down here, though, energy not doing that well actually over 5 days. And more importantly, look at staples. Staples and healthcare, the defensives and even financials have not really been coming up anywhere near as much as the rest of the market. Let's get into the charts together. We'll start off here with yields. Do remember that US 10, 20, and 30 years should all be paid attention to. If we actually load up a US 30 year, which I think is probably one of the more interesting ones at the moment, you can see here it's come down relatively significantly, but this will be the chart that everyone needs to be watching through this week's inflation report and more importantly into the future. Look at what happened since July and more importantly August into September. This was a significant move, 3.8 to 5. No wonder the market started to freak out. But, in other times, the markets would have freaked out a lot more than they are now. It just shows you how resilient they've been in comparison to how terrible technically the things in the world do look. And that's why sometimes we have to leave our opinion at the door and focus on more what the charts are telling us. The volatility of the volatility's dropped out, as has the volatility itself. And of course, if we look at MOVE Index, which is basically the bonds market options vol, you can see here that was up a little bit on the session. So we are looking at the bonds market option volatility as well as the rest of them. Interesting to see the bonds market actually starting to get a little bit freaked out while the rest of the markets certainly weren't. Copper markets haven't reacted that much to what we saw coming out of China. They're kind of stimulating the economy, talking about, I think it's close to 200 billion extra stimulus. And it's what we expect more of from the Chinese market. They're going to have to support their economy, which is very, very bad. And we expect that in the form of stim packs. So 200 billion, I believe, at this stage is what we're looking at. But it didn't have that much of a driver on copper. So obviously the market's not super convinced, at least from the metal standpoint. Let's move over to central banks, and they are at it again. Look at them injecting the terrible things, really. When you think about it, you want the market to sell. How can it sell when every time the market sells off, you see this injection or this relaxing of credit behind the back? Clearly something broke we don't know about yet. When those yields went up, something happened, and you can just see it here. Look at that. No, it's not even a insignificant amounts, huge amounts. And this is something that I've just got to say is just ridiculous. Every time the market comes down, well, why are the bulls so correct this year? A lot of it has to do with instantly you get that kind of reaction. So central bank liquidity is on the increase. Now, this is the one I wanted to discuss today, and this is the market internals of financials versus the S&P 500. Basically, since March, we haven't really seen financials doing very well. And they're kind of telling us that there's something wrong. And of course, we know that because, well, we've seen it with all those big banks, all those smaller banks, regionals going bankrupt. And of course, Jamie Dimon going and hoovering them all up. But more importantly, I saw a few of those bankrupt banks in America while I've been over there recently, and they looked like they were doing quite fine thanks to Jamie Dimon. But over here, financials and S&P, this is the chart that we need to be watching. And it doesn't look super strong on the internals. If this falls through, so I think marking out some alerts on the new lows, it could tell you there's actually a problem that's going to come for the rest of the market. And financials often show the break earlier than the rest. So some things to keep in mind would be things like KRE versus S&P 500 as well, which is regional banks. And you can see here it made a new low recently. So again, May hasn't been that strong. It's showing you that this recovery in the market is not being led by the things that you usually want to see it led by. And look, this has been a consistent pattern for quite some time. Financial bank institutions haven't done that well, but you can see after that 2008 crash, we saw that huge injection. And obviously we saw 2020, a huge injection, and everything was looking okay throughout 2022 until March. So you can really see that how much the Fed has supported this market through really supporting these banks, and how it actually should be a lot worse than it is right now if they hadn't have done that. Let's go to Dow Jones Transportation Average Index. This one here has closed above the 20 moving average, which I think is significant. And what we're seeing across the board is a lot of indices went above some of our key supply zones on the left-hand side. And they're kind of showing us that this really could be the bottoming of the market, at least for the temporary period. Maybe 2024 is where we're going to see more selling when we get that official recession call, or we get closer to what we're probably going to see, which is a recession in the US. First home builders, or home builders in general, let's have a look here. Nothing much going on from the home builder standpoint. Didn't get back to our resistance level. You can see here semiconductors as well. They're coming into the supply zone, hitting it and finding sells. I wouldn't blame bears sitting right on that level. And then, with stops above the highs and saying, well, I'm going to short the semis right here. If you're going to have a go at it, like from a technical standpoint, it makes sense. You've got supply, you've got a key level, and there's quite a lot of other things that have gone on through this zone as well. So semis at certainly a critical point. Let's move over to the US dollar. It keeps weakening, but it hasn't gone underneath that 105.30 zone yet. So that's going to be, again, another pivotal point. And I think the US dollar at this stage is just kind of floating around where you would expect some kind of buyer to come in. And the reason, at least temporarily, and the reason why is the 20 moving average. It's back at that demand. You can see the 20 moving average here. And while I kind of think it's going to do this, what I'm looking for first is probably I'd like to see a sell followed by a rally followed by a sell later, and that marking in a top for the US dollar. Has the dollar top though? We don't really know yet at this stage, still in a swing trade uptrend and in a medium day trade kind of downtrend at this stage. Gold's done okay to stabilize itself. It's continued to make a series of higher peaks and higher troughs, and we still remain bullish on gold into the 1870s.